Welcome everybody, S-Tier Trader here. It's been a few weeks since my last trade review, and I'm really excited to actually start rolling these trades out to you guys again. I'm actually sitting on 3 different weeks of trade reviews, so month number 2 is all complete. I just gotta actually put them into video format here. This video here, this is week number 2 of trading month number 2. So if you recall, my last trading review, I hit 35 pips on that week. That was week number 1. This is week number 2 of trading month number 2 here. I took 3 trades that trading week. All 3 of these trades, they took place during the week of February 28th. So the specific dates were February 28th, March 1st, and March 3rd, 2022. Before I get into these 3 trades, just remember that I aim for complete transparency in every single one of my price engagements. If you want to follow along with my trades, be sure to go to tradingview.com and refer to the forex.com data feed when I'm trading forex, and then the ESH 2022 data feed when I am trading index futures. The price action that you see on those charts is the exact same that you'll see on these price recordings right here. If you're still skeptical for whatever reason, that's completely fine. Know that I have my personal time listed in the bottom right hand corner, however. Timestamps for all 3 of these trades are in the description. We got 3 different trades to look at, so let's get right into this. On to trade number 1. So we are going to start this trade review by showing you guys my first stop loss hit of 2022. That's right, I actually took a loss on this trade. So this trade occurred on the euro dollar, otherwise known as the fiber, on Monday, February 28th, 2022. Price made a huge run lower to start the week. I'm talking massive, over 150 pips on the sell side to start the week. This occurred because there is a large gap up on the US dollar, which you can see here. Now, ICT hasn't taught YouTube how we interpret natural gaps, so I'm not going to go into this too much. Just know that I am long US dollar for the week in part of this natural gap. Therefore, I would be short foreign currency for the week. So when I am short foreign currency for the week, as a day trader, I am looking for price to run previous day's lows. This is the mindset of a day trader. We're looking for previous day's lows when we're bearish, and we are targeting previous day's highs when we are bullish. You can choose to look for intraday liquidity if you want, like Leonid369. If you saw that video, they're a bread and butter trader. They like to target intraday liquidity. However, as a day trader, and my personal preference, I know that institutions are specifically operating off the daily chart. So the people that are actually trading the algorithm, they're operating off of the daily chart. My trading mindset is to be like a flea on a lion's back. I know that the lion is going to be targeting previous day's lows when the environment is bearish. So as that flea, my job is to latch onto that lion and just try not to get bucked off in the process. Now that I have my higher time frame directional bias regarding price, we need to now determine the time factor of time and price. So the time component of trading is what will often knock me off the lion's back. If I'm a flea on the lion's back, time is what will usually desync me to what the lion is doing. Notice that I traded on a Monday. I usually do not trade Mondays unless something very specific occurs, and we actually saw that in the US dollar. So let's go back in time. For you old school ICT traders, if you have seen the Scout Sniper series, you're going to know what I'm talking about, specifically regarding one shot, one kill trades, otherwise known as OSOC. So, as an OSOC trader, if you were bearish on the week, we would expect the high of the week to form on a Tuesday. We would then hold that trade until Thursday, where we would expect the low of the week to form. So, recall in my prior videos, I was a one shot, one kill trader when I entered the private mentorship, and even for a couple years after I entered the private mentorship. I then learned to adopt a day trading model as well. I have 2 models, a day trader model and a one shot, one kill model. I'm still in the process of learning which model I should be using for which week. If I were using my OSOC model, I would have waited until Tuesday to look for that short in the market. However, I have been using my day trading model in this YouTube series, and it's been the most effective this year so far because during 2022, at least up until mid March, the Forex market has been in a tight consolidation. It hasn't been moving. Now, it's important to note that while I have two models, you absolutely do not need two. One is more than enough to find the success that you're looking for if that's becoming a professional trader. And know too that even if I use both models to their maximum potential, I am still going to take losses sometimes. They're unavoidable. Losses are going to happen. And actually, losses are excellent opportunities to learn. The thing with losses is that they can be uncomfortable. They are obviously uncomfortable when you get stopped out and you lose. However, they're also uncomfortable when you go and study them later. It's easy to, instead of reviewing that trade that you lost on, it's easy to just kind of throw it in the trash can and attempt another one later on and just kind of ignore what just happened. However, losses are fantastic in helping you identify items that you can improve on as a trader. So for myself, I've learned that sometimes if I lose, it's because I'll mentally make a mistake. Other times, I'll just simply use a tool incorrectly. In this trade specifically, by reviewing my loss, I learned that I pulled out the wrong model at the wrong time. Had I waited and used my OSOC model, I likely would have not taken this loss on the Monday. I've identified a signature from this trade on when I should forego my day trading model and when I should use my OSOC model instead. It's still a work in process. However, I am developing because of this. By overcoming the uncomfortability of studying my losses, I have been able to take away great insight that will certainly aid me in becoming a professional trader. Losses are uncomfortable, but if you can get over this and study them, they are a gold mine for development. Let's wind up trade number one. My stop loss did its job, and now I have started this week immediately with a 22 pip loss. When I was a newbie, I certainly would have been debilitated from this loss early on, and it would have affected my trading for the remainder of the week. Perhaps I would have been too aggressive to try to get those pips back, or maybe I would be too fearful of losing more pips and I would avoid trading altogether. I have since matured massively since my newbie days, which leads me to trade number two. Trade number two takes place in the same market, the same time frame, with the same directional bias. The difference in this trade is that it occurred on March 1st, 2022, and instead of the London session, we are now trading in the New York session. Let's focus on the directional bias to start with. In my infancy, I would take a loss one trade and then immediately change my directional bias the next. As I've matured, however, I am now more easily able to relate to ICT's concepts on directional bias. In the YouTube mentorship, ICT has stated that directional bias does not mean every day price is going to move in that direction. It doesn't happen. Directional bias is instead learning to trust that price will likely go to that weekly draw on liquidity. However, it doesn't always do so in a straight path. In this case, price needed to dig deeper into a premium market before selling off. My trade on Monday was simply me getting into the market too early. When price traded higher after stopping me out, it would have been very easy for my old self to decide that I had the directional bias wrong and I would focus on buying the next day. Instead, I've learned that we do not chase price. We stick to our directional bias, and if losses happen on the way, well, then that's fine. That's why we operate with a stop loss and have strict risk protocols. After my loss on Monday, I knew I wanted to see two things occur before re entering. The first is that I wanted to see a high form on Tuesday, just like my OSOC model wants to see. I then wanted to see price break market structure bearishly. I left London session alone and chose to trade the New York session instead. You might remember in a previous trade review that I've been having trouble looking for continuations in New York to start 2022. This is because the foreign exchange market has only been offering day trades. Once I saw that high form on Tuesday, however, and then the market broke bearish, I felt confidence that price would deliver an opportunity to engage in a continuation pattern during the New York session. I wake up and price has done exactly what I wanted to see. Price made the high in London and then it broke bearishly. Now I begin looking for a short in the New York session. I enter on a 5-minute chart, which is just simply a bearish order block. Remember, I put my entries below market price during shorts in order to account for spread. I'm now in the trade, and there's just nothing left to do other than watch this beautiful price action paint on my chart. Prior to price running my first take profit, notice how another bearish order block forms. If I weren't at work and were actually in front of my chart, I absolutely would have taken another short at this bearish order block, which would pyramid my position. This is one reason why I'm just so excited to actually trade for a living, as I'll be able to capitalize on these pyramiding opportunities. Instead, I have to miss out, and I ain't worried about it, you ain't worried about it. Price continues lower and it hits both of my take profits. 50% of my position is taken off at 26 pips, and the other 50% of my position is taken off at 46 pips. This nets me a total of 36 pips on the trade. This not only offsets my loss from yesterday, but now I am actually up 14 pips net on the week. I'm still not at my goal for the week, however, so off to trade number 3 we go. Trade number 3 takes place in the E-mini SMP, and prepare yourselves for one of the absolute best entries you will ever see. Before we get there, you might be wondering why I actually switched asset classes. I went from the Forex market to the index futures market. The answer is that the US dollar had already delivered to my weekly draw on liquidity. The bias in the dollar was no longer clear after hitting this draw on liquidity. The index futures developed a clear bullish bias midweek on the higher time frame. I am now looking to be the flea on the lion's back in the spoos. Let's take a look at where my buy limit order is. What do you see on the left side of my entry? Pause the video. There is a pool of sell stops right here. If the market is going to go higher, which is what my directional bias suggests, institutional traders are going to want to buy at the lowest price possible. Now, who is actually going to sell to them at such a low price? It doesn't really make sense, right? Who wants to sell at a low price? Well, the answer are the retail traders. Those retail traders are buying at what they see as support. Their sell stops are resting just below the support level, just like every single retail book tells them to do. The algorithm will look to take price lower, offering those sell stops for institutional traders to buy. I set my buy limit order in London and off to bed I go. Pay attention to the time element. New York session doesn't start until 5 a.m. my time, which is 7 a.m. Eastern Standard Time. It is not yet the New York session. See how price goes lower and hits what retail sees as support. Retail traders are buying when price either hits the support level itself or when price reacts away from it. They are all putting their sell stops below the support level. Price ends up wicking higher before running into the support again. Again, retail is buying the support level. Price has now gone to this support level, 5 times now at this point? This will certainly boost the confidence of retail traders. They see this as a very strong support level. The algorithm is instead doing what is known as engineering liquidity. The algorithm is enticing retail traders to enter the market. The algorithm wants them to be in there so that they can put their sell stops below the support level. These retail traders act as liquidity for the institutional traders. Keep watching the time. 5 o'clock hits my time, and it's now the New York session. Watch how price immediately stabs through the support level and triggers my buy entry. Anyone who had their sell stops below the support level are now out of the market. The algorithm immediately runs vertical from here, as it has done its job of pairing institutional buy orders with retail sell stops. Notice where price shifts bullish market structure after taking the sell stops. Do you see anything? Pause the video. A bullish order block has formed here. Watch how price immediately retraces into that bullish order block, creating yet another bullish order block. If you weren't comfortable buying when price ran the sell stops, like where I bought at, you could take the confirmation approach instead. This approach waits until a market structure shift has formed after stops have been taken. You could then buy at the bullish order block. For myself, I would have absolutely loved to have been awake here, as I would have pyramided my position by adding another long. This long would have had less leverage than my initial trade. Instead, I missed the chance to pyramid again. However, I ain't worried about it. You ain't worried about it. Price soars higher from here and hits my take profit number 1. I awake to see 75% of my position taken off. I move my stop to break even, just like my protocol says, and I keep one eye on the chart while the other eye is getting ready for work. As I am getting ready, I decided that the better move was to close my trade completely at my take profit number 1. By closing the remaining portion of my trade, I'd be up 45 pips on the week, which is nearly double my goal for the week. Perhaps I could have stuck with my take profit number 2 objective. However, I felt my workday would be better if I locked in another successful trading week rather than worrying how price delivered the remaining 25% of my position. That wraps up my week number 2. 35 pips in the first week plus 45 pips this week puts me at 80 in 2 weeks. Remember, we only need 90 pips a month to double our money every single year, and I've almost hit that in 2 weeks. If you've learned anything from this video or just enjoying the content, please go long on the like and subscribe buttons. This week, you saw me take a loss and how I managed to overcome it. Now, it's been 3 weeks since I released my last trade review. As I stated in my month number 1 review, March and April are my busy times of the year. So I'm working lots of overtime and I'm doing school as well. So it's kind of nuts. I've already traded weeks 3 and 4 of month number 2. So now it's just a matter of finding time to put those videos together. So expect those videos to come out as soon as possible. Once those videos are out, I will be putting out some TradingView tips and tricks videos, as well as trade psychology videos. I'll be back to trading itself the first week of May, and month number 3 will officially begin then. I'm also very excited to do my trading journal series, so stay tuned for that first installment. That will come in May as well. That's all I've got for this week. Thanks for watching, everybody. Good luck and good trading. If you want to see my first week of trading for month number 2, click the video on the left. If you want to see me review a fellow ICT charter member's trade, click the video on the right. Please go long on the like and subscribe buttons. Thanks for watching.